So last time we were talking to Amy, we were inevitably saying there would be an awful lot of conversation about MTD over the next few months. And sure enough, two very big topics that we need to look at today. Curiously, Amy, one of the things we want to talk about is we've focused so much on quarterly filing and the rush to be ready for April 2026. We kind of pushed the year-end stuff to one side. We'll worry about that in April 2027. People are now starting to look at it. And the thing they're most worried about would appear to be, of all things, a lack of tax computation.
Yeah, so there was an article on AccountingWEB recently by Robin the Tax Girl that gives us a bit more information in terms of how that final tax computation will be produced. And there's a key difference between the current self-assessment and how it's going to work under MTD, which is who is really preparing the tax calculation, who's responsible for producing the final tax liability figures. And that's actually shifting from the self-assessment, or usually the agent, to HMRC themselves. So at the moment, you collect the necessary information from your client, you process it, you draft the return, you send the client the return to review and state that they're happy with the figures, and then you file it with HMRC, job done. The difference under NTD is that once you are happy with the inputs and you agree the inputs with the client, you submit on your software to HMRC, and HMRC will send back the tax calculation, and they say that will be sent back in real time, which I assume means immediately. The agent then needs to agree and confirm the tax computation that HMRC has sent and then submit it.
And the concern here, of course, is that when we have dealt with self-assessment over the years, none of the other providers of software, actually there is one provider of software, but we won't name names, no software provider does their own computation for tax returns. It's the revenue who produce it, send it out, and that's why over the years we've had all of these issues with slight differences between the accuracy of the return and what the law actually says. It's been common across all software, and the reason for that is that we have this commonality of computation. Suddenly we're going to be in a position where software houses are either going to have to, for the first time ever, produce their own computation, or I guess they're going to have to just leave it to the end and let the accountant deal with this however they see fit.
Yeah, so I mean, we should, in theory, have no problems, have no real difference between the way it's done now and the way it's done under MTD, because as you say, the revenues calculation, their underlying calculations should be correct, and it should all just match to what we're expecting and what the tax figure should be. However, we have seen recently, even on this month's Tax TV, you will see Tim Good discussing a case that he was very involved in. He represented the taxpayers, and it was all about a calculation of top slicing relief, which HMRC had done wrong. And because he was checking the figures, which, as you say, not many software houses, not really anyone is doing, he noticed this error, which was an error in HMR system, and it's not the first time, and I don't think it would be the last time. We've also had an issue where HMRC have incorrectly added Class 2 national insurance to self-employed taxpayers' tax returns, again recently. So it's not enough to say that the HMRC calculation will be correct.
So it's essential, I guess, that the agent is happy to go through this computation, is prepared to work through it and make sure they're happy with it for the client. That's a fundamental part of the journey going forwards. But I think a more fundamental part of the journey is sign-off, and accountants are going to have to decide when they get the sign-off from the client in this particular program.
Yeah, people do. So in the article, Robin questions when the client sign-off should come. Should it be the client agreeing to the draft figures that the agent sends to HMRC, but then the agent has responsibility for agreeing the final figure with HMRC? Or should it be that the agent sends the figures off without client agreement, and then the client agrees once they see the final tax computation. And neither of those is necessarily the right answer. Does that mean we need two levels of client sign off, which obviously is going to add a lot of time and quite a lot of confusion as well for the taxpayers? So there really needs to be, as you say, this conversation between taxpayers, agents, professional bodies, HMRC, insurers. Maybe we need to agree potentially on a change to engagement letters that currently say, I will tell you how much tax you owe, because now it's actually not the agent telling the taxpayer how much they owe, it's HMRC. But if the engagement letters don't change and then HMRC makes an error when they send back the tax calculation, will that fall back on the agent? So it really does need to be discussed and considered. It's quite an important part of the process.
And the second thing to pick up on this month, also MTD, we have focused so much on joining MTD. When will my turnover cross a particular threshold? Do I have to do it then? When can I wait until? Do I add them together? All of that stuff has been going on for ages. And what we hadn't looked at is when we're allowed to leave. So I guess the question, Amy, is when are we allowed to leave MTD?
Yeah, so this is an article by David Wright from the ATT, and it's called I'm an MTD Taxpayer, Get Me Out of Here. And yeah, it's looking at when you're in MTD because your qualifying income was above the threshold, which is 50,000 for April 26, but then as we know, reducing gradually towards 27, 28, when it'll be 20,000, and then we don't know what's happening after that yet. But what happens when you're in MTD and then your qualifying income falls below the threshold? Some people might be thinking, oh, I'll just automatically drop out of MTD and stop having to comply with the requirements. But actually, there's a 3-year lock-in, which makes sense because it's to stop, if you have turnover that kind of dips below and above the threshold, it's a lot to change your processes every year to go into MTD and then out of MTD and in and out. So this 3-year lock-in is to remove that volatility, I guess, but it does mean that even where taxpayers have some qualifying income, so if you cease to trade and you remove all your qualifying income, then obviously you don't need to continue filing nothing for 3 years. But if you have some qualifying income, but it's below the threshold, it needs to be below that threshold for 3 years before you can stop.
And we keep talking about this, obviously it's mandatory above a certain level, and we keep focusing on that. If you had a client with a turnover of £20,000 and you want them to join MTD at the earliest point, there's nothing to stop us doing that.
No, absolutely not. And it might be a good idea, especially if you've got lots of clients that are above the threshold. So you as an agent, you've changed or you're using MTD compliant software, and you know that eventually these taxpayers with the £20,000 income, it's not actually that far away, the 27, 28 tax year, when they'll have to join anyway. So it might be worth just bringing everyone in now and just getting them used to the process, because we don't know what's happening after 2028, but it's probably likely that eventually, if this works, if it goes to plan, they're going to bring everybody, even those with lower incomes around the 10,000 or even below, that everybody's going to be in MTD eventually. So yeah, there's nothing to stop you bringing them in now.
And to pick you up on something there, you were talking about if your mandatory income stops, then obviously full cessation would mean we could leave MTD. But of course, if you have different types of mandatory income, it will be relatively common, I guess, that somebody might cease to trade but continue to have property income. And the fact that property income doesn't get to the £50,000 is irrelevant. You still have property income, so then you couldn't just walk out of MTD.
Yeah, so let's say you've got a self-employed taxpayer who also has some property income, and their self-employment income might be 40,000, but then their property income is, say, 15,000. And if they stop that trade, so they no longer have that sole trader income, they will drop below the threshold because they've only got the 15,000 from their property, but that property income is still qualifying income. So actually, even though it's below the threshold and the kind of main sole trade has ceased, they would have to continue complying with the MTD requirements for that property income for that 3-year lock-in period.
And so far we focused on we're in MTD already and something changes. Worth reminding everybody, of course, that the decision on when you join MTD will be based entirely on what happened the year before. So between the year before and starting MTD, you might cease to trade, something like that. In that situation, obviously you wouldn't then be expected to join MTD at all.
If we've ceased to trade in that window, we wouldn't be expected to join MTD. No. So yeah, as you say, they're looking at the year before. There is that 1 year lag period, but it wouldn't make sense if there's nothing to report, then there's nothing to report. So yes, that would be acceptable. But again, if they just reduce their trade or if they maintain some qualifying income, then those taxpayers would still have to join MTD. What you could do rather than reducing down your trade or ceasing to trade in that time, if you weren't planning to cease to trade, but you did think, oh, maybe I'm going to wind up, or your client, I suppose, thinks, maybe I'm going to wind up and retire within the next sort of 3, 4 years, there are other options to keep those taxpayers out of MTD, but it's a very specific scenario. So we are talking about those who are planning to retire or to wind up their business in the next few years. They could consider bringing maybe a friend or a spouse on as a partner, changing the business, the sole trader business, to a partnership. And as yet, we don't have a date for when partnerships are going to be brought into MTD. We do have a lot of people, certainly in the comments to David Wright's article, and kind of generally on any answers and on LinkedIn, who do say things like, oh, I'm going to make sure I keep my turnover at 49,000 so that I don't have to join MTD, or I'm going to tell all of my clients to form partnerships or even become limited companies or join the Plymouth Brethren so they're digitally excluded. But these are all quite significant changes and admin burdens, and in the case of the Plymouth Brethrens, would have a significant impact on all aspects of their lives. And actually, it's quite an extreme thing to do when really, as I said before, most people are going to be brought in anyway. So probably limited companies eventually, if it works for income tax. Probably going to work. They're going to bring it in for limited companies. Partnerships, we don't have a date for it yet. We used to. They were going to bring in partnerships and now they've pushed it back indefinitely. But again, I think it's quite likely, we can quite safely say that they will bring it in for partnerships eventually. So it's only, as I said, for those clients who are planning to retire before, I suppose, 28, 29, 29, 30, when we think partnerships might be coming in, they could form a partnership for the next 3 or 4 years, and then keep them out of MTD. And probably these are the ones that are the least willing or are likely to be able to or want to deal with the massive changes. They're ready to retire. They don't. We see these comments all the time, even from accountants on AccountingWEB. I'm retiring in a few years. I really just don't have the energy or, inclination to change all my processes. But we are talking about a very kind of small niche category of taxpayers.
And the point, of course, we keep coming back to in these conversations is this is all about communication. This is all about making sure we speak to our clients, understand who is mandated from when, who's going to be beneficial to join, how long they'll probably be in there. And to extend from, rather pathetically, to extend from the title of David's article, I guess the way we win stars for camp over the next year or so is we make sure that we are looking at our clients now, having those conversations with clients to look at what needs to be done over the next few months, when we can do those things, and what the expectation of all parties will be.
I think this is true. I think a lot of the comments are very black and white, and most people who do take to their keyboards at the bottom of AccountingWEB articles and on social media in general seem to have this view that as every time a question mark is raised over a particular element of MTD, it's just right, that's it, it's not going to happen, it's dead in the water, I'm retiring, or I'm going to make all my clients into limited companies, or just get me out of here. Whereas having the conversations with HMRC, with the professional bodies, with each other, determining, which taxpayers might be able to benefit from a change such as forming a partnership, but actually accepting that for the vast majority of our self-employed taxpayers and landlords, they are going to need to come onto MTD, and we need to work together with the revenue, to iron out these issues and work out how it's going to work.
And of course, we also need to keep talking to HMRC and make sure that we can iron out these little problems that we're finding as we move towards that important April 2026 date. Amy, thanks as ever. Very useful.